I believe we have a quorum, so we will go ahead and get started. I am so pleased that everyone was able to join us today for our discussion on the business value and best practices for managing ESG. In recent years, but particularly over the last 10 months, we have seen companies across various industries facing increasing demand from stakeholders, everyone from consumers to investors to analysts and media, requesting additional guidance around disclosure practices related to environmental, social, and governance factors. However, the standards for reporting those practices is often changing and varies by market and industry. Over the next hour, our expert panel will provide their thoughts on how companies should be managing their ESG reporting and disclosures, including sharing some best practices and their outlook for 2021. We invite you to ask questions in the Q&A box throughout the conversation, and we will leave time at the end of this presentation for additional questions. I'd like to now hand it over to my colleagues Gus Okwu and Madeline Patterson, who will be moderating today's conversation. Gus is an EVP at BCW based in New York, leading our financial communications and investor relations practice, and Madeline is a VP based in Chicago, overseeing our CSR reporting team. Gus, over to you.
Thanks, Sydney. Good morning, speakers, and to those of you joining us on this call. As Sydney mentioned, I run BCW's U.S. financial communications practice, which includes counseling our clients on ESG disclosure and reporting. And our ESG disclosure and reporting effort is done in collaboration with Madeline Patterson, who leads the firm's impact reporting team and her team in Chicago. So I can think of many words that we can use to describe what most of us went through last year, but the one that stands out to me is challenging. I'm sure that most of us found it challenging to abide by the shelter-in-place rules we were forced to live with. For some of us, it was a real challenge to accept the notion that, my own seemingly innocuous actions could potentially impact a group larger than myself. And lastly, for many of our clients, it was a challenge to manage their business on a daily basis and concurrently respect the needs of their stakeholders while responding to the impact of COVID-19. One of the few bright spots that emerged from 2020, and most likely driven by the damage wreaked by the pandemic, in addition to last summer's BLM movement, was an increased interest and focus on ESG issues. The impact of the pandemic and BLM forced corporations to realize that human capital concerns need to come before corporate profit, and that doing good typically results in doing well financially. So we at BCW believe that these ideals will continue to carry through in 2021 and expect even greater adoption of ESG and the premise of purpose. So we arranged today's event with this in mind and invited a special group of speakers to guide us on the discussion of what we should expect in the world of ESG in 2021. So with that, let's meet our speakers. Eric, good evening, good evening in Geneva. Can you provide our listeners with a brief overview of your responsibilities at Pictet Asset Management?
Yes, good evening, Gus. I'm head of ESG at Pictet Asset Management, meaning that the role and the role of my team is to help our portfolio managers and analysts better understand how companies incorporate environmental, social, and governance factors from a strategic point of view, but also in the way they run their business on a day-to-day basis. So we provide them with an additional lens to look at how companies operate, and we do that through a range of ways, by providing them with third-party data, by putting together proprietary data or evaluation tools, but also by coordinating our active ownership activities, including how we vote at company meetings and also how we engage with companies on specific issues of concern to us as investors.
Right. Tremendous. Thanks, Eric. And again, thanks for being part of this. Let's go to Angela Baker from Qualcomm. Angela, your turn on the mic. Can you provide us with a brief overview of your responsibilities at Qualcomm?
Absolutely. Thanks, Gus. So I'm Angela. I run corporate responsibility and sustainability at Qualcomm, which includes our ESG portfolio, and really working to integrate ESG, or environmental, social, and governance, across the business from the board of directors on down.
Tremendous. Thanks, Angela. Let's move on to Lisa of Freshfields. Lisa, are you on the call, and can you provide us a brief overview of your responsibilities?
Hi all, I'm Lisa Bieber. I am counsel and head of shareholder engagement and activism defense at Freshfields. We regularly advise boards of directors and executive management teams on governance issues, which increasingly is including ESG issues, and also work with those teams to think about how to defend against activists and how to manage their stakeholder relations today.
Tremendous. Welcome, Lisa. Thank you. Finally, last but not least, good afternoon from London. Selena, are you on the line and can provide us with a brief overview of your responsibilities at Gibson Dunn?
Hi guys, Selena here. Many thanks for including me as part of this panel. I'm Selena Zagan. I'm one of the international corporate partners in Gibson Dunn's London office. My practice focuses principally on international corporate finance, public and private M&A. I also have an advisory practice which is focused on corporate governance, shareholder activism, and securities law advice. I am one of the co-chairs of our UK ESG group and our firm's ESG global practice. I've also recently just stepped off as a serving non-executive director of a FTSE company, which has been particularly invaluable in terms of providing additional insights on corporate governance and indeed ESG issues. And finally, I'm quite heavily involved in diversity and inclusion issues, which is naturally relevant to the S of the ESG, both internally within my organization and externally.
Tremendous. Thank you, Selena. Appreciate your participation. And thanks to all of you speakers as well. We look forward to hearing your insights. So let's dive right in. Madeline, handing it over to you right now for our first thought starter.
Excellent. Thank you, Gus. Appreciate that introduction. And thanks to everyone for joining us today. I'm going to kick off with the discussion with Angela Baker, talking about the landscape from awards and rankings to investor inquiries. We know that having a strong ESG strategy is no longer a nice to have, but it's an essential part of business. Transparency and impact are the two keys that I see as critical for this conversation and themes that I anticipate will be repeated throughout this webinar. Angela, thanks for being here today to discuss the ESG landscape as you're in the day-to-day of all of this, leading, implementing, and forming this strategy for Qualcomm. And I think looking at this slide, some of our viewers might think it's a bit overwhelming. So let's start there. How do you navigate the crowded landscape?
Absolutely. I think, so I agree, it can be overwhelming. And I would say that it's important for companies to look at what their stakeholders are asking for and what is driving their purpose as a company. So, from our perspective at Qualcomm, we are looking at what our investors are looking to see, what's relevant for the semiconductor industry. We want to ensure that we're, disclosing information that's relevant, of course, to our industry, and that's important to the work that we're doing. There are a number of rankings and ratings to which you could respond, of course, and we about 2 to 3 years ago did sort of a landscape analysis at looking at what are our key stakeholders, our employees, our policy makers with whom we engage, our investor community, of course. What are they looking at? And what types of information do we want to be putting out publicly that we know are important for those stakeholders? And then engage with a number of internal stakeholders as well to see what's relevant, of course, from our board of directors to our executive team to other folks within the company. I think you really have to do that. Each company has to do that on a case-by-case basis because it can be overwhelming. You certainly can't respond to everything. And of course, many of the rankings and ratings agencies ask for very similar information, but many of them ask for very different information. So you want to make sure, I think it also comes down to sort of a capacity issue of the team that's working on ESG at the company and can be responsive. We work very closely, as I said, with our board of directors and our executive team, and of course also with investor relations. And then it is a really robust process, I think, to sort of get this information out in a public manner and make sure we're being responsive, to those stakeholders.
That's a great point about the quantity of data and the overlap. How do you approach the desire for more transparency, but understanding that more data isn't always better data? Where does quality factor in, and how do you think about that personally?
Yeah, I mean, I think that's really important. The data is one part, right, around disclosure, and certainly I think we've seen an increased interest from investors and others to disclose more data, but I think there's also been an ask, rightly so, to disclose what you're doing about that data. So whether it's diversity and inclusion or environmental standards or corporate governance, are you putting targets out? Are you working towards specific goals in supply chain management, privacy and security, whatever the issue area is? And what are you doing to meet those goals? What are the actions, you as a company are taking to really move the needle on whatever the issue is? Because data can be subjective, of course, and you want to make sure that you are obviously disclosing data. I think it's really important to show progress or no progress or whatever, whatever the data says, but to also say, here's what we're doing about it, or here's the actions we're taking, or here's what our plan is. But we think this is important as a company for these reasons, and this is why we're going to focus on it, and this is how we're going to focus on it. Or if it's not relevant to you, or you can't disclose it because it's proprietary or whatever it might be, to also put that explainer in as well, because again, every company is a little bit different and has different issues or different challenges that they're facing.
Excellent, thank you. What advice would you give for your peers or others who are new to this space looking to improve their disclosures, whether that's a process you've learned or you've implemented at Qualcomm?
Yeah, so we actually just did a big exercise around this over the last year or two, and I imagine most companies go through this as well, but looking at what is being asked of you, whether it's through investor rankings, whether it's through shareholders and the shareholder meeting, whether it's through your investment community, regulatory changes or regulatory frameworks. Of course, we'll see some new changes with that coming. And then what do you have publicly available? And what else could you be disclosing? I think one of the things that we did over the last year at Qualcomm was that there were things that we were doing as a company. We just weren't telling anybody about them because we hadn't been disclosing them before for one reason or another. And so we had a big effort, and we'll continue to have a big effort on more transparency and disclosing more information. I think there's also a lot of mechanisms by which to disclose information. So I think traditionally we think of the annual sustainability or corporate responsibility report, which I think is important. Of course, I think websites and other, there's lots of financial disclosures that are happening, right? Whether it's your 10K filing or your proxy statement, there's a lot of ways, I think, to get this information out or to get this data out. Whereas before, I think it was traditionally just seen as like this one report you put out at one moment in time. And of course, the data is fluid, progress is fluid. And so you want to be reactive to sharing new information when you have it with key stakeholders, and also not just like doing it once a year and then not talking about it again.
Right, exactly. And it looks like we have a question in the Q&A box. Does the merger of SASB and IIRC represent a shift towards integration in the ESG framework space?
Yeah, so I mean, I think we're hopeful that it does. It certainly was welcome news when it came, in September. I think it was in September. And I think that we've seen other organizations express interest in joining that as well. I think we're a ways out from it, in all honesty. I mean, I just think that it's going to take time. There's so many metrics right now. There's so many different rankings. It's not uniform. I think one of the frustrating things for folks that work on these issues is that if you were only looking at the rankings, which I encourage, folks at Qualcomm not to do, and I'm sure a lot of people, you have to look at a lot of different things, but you could rank high in one score on corporate governance and low on another and score on corporate governance because they're just asking for different things or they're interpreting the data in different ways. And of course, if you're trying to work on a program and set tangible results, that can be kind of frustrating. So I do think that more integrated reporting is needed, and I welcome that, the Big Four and the World Economic Forum or SASB and IIRC and others joining. I just think we're a ways out from it because I think there are so many players in the game, and it will take a while to get everybody sort of aligned. And the second part of that is, of course, every industry is a little bit different. So you can't just have one standard. You know, what is important for an oil and gas company is different from what's important for a semiconductor company is different than what's important for a retail company. Certainly there are things that are similar, right? Everybody can try to lower their carbon footprint, or everybody can have good corporate governance, but there are certainly different issues in supply chain and others that industries face. And so I think to have one set of standards there's no one size fits all. So I think it'll have to be a fluid process. So I think it was a good step, but I still think we're a ways away from, you know, one reporting framework.
Absolutely. Yeah, wouldn't that be the dream? Thank you, Angela. This was really helpful. I'm going to hand it over to Gus to kick off our next topic area. Gus, you're muted. On mute.
Apologies for that. I thought the hands of God would somehow help me in that area. But anyway, so let's shift the discussion now towards one of the major challenges that financial regulators in the U.S. and other parts of the world currently face. And that is the direction being provided by financial regulators on ESG investing, primarily in the U.S. and Europe, and also includes a lack of standardization. So with that said, the U.S. is a different starting point regarding key aspects of ESG investing compared to what has transpired in Europe. And while demand for ESG data and transparency is increasing, the regional differences in regulation and standardization create a challenge for multinational companies and asset managers with the U.S. and European presence. So with that as background, Eric, can you provide us with I know it's very tough, it's a very huge piece of legislation, but can you provide us the highlight of the key provisions of the EU taxonomy for sustainable finance? And as a follow-up, would love to get your thoughts on how you think that might impact U.S. issuers and investors. Eric, I think might be on mute.
Yes, can you hear me?
Yes, we can, Eric. Thanks.
Good. Yes, Gus. The headlines from Europe is that the world of ESG investing is undergoing a real revolution that started last year and that will unfold over the next couple of years. And that revolution is very much driven by the EU Action Plan on Sustainable Finance, which has many aspects attached to it, in that it impacts us as investors, asset managers, asset owners, intermediaries, fund distributors. It impacts rating agencies, who will be under closer scrutiny from the regulator, just as credit rating agencies today to us, there is a certain amount of oversight. But that the same level of oversight doesn't quite apply yet today on rating agencies. So it is impacting investors, intermediaries, but it is also very soon going to impact companies, issuers, and reporting standards. The bedrock of this armory of regulatory developments is, as you mentioned, or as you hinted at, the green taxonomy. Now think of the green taxonomy as a catalog of activities that are deemed to contribute to a range of environmental objectives. One of those environmental objectives is, for example, the need to mitigate climate change and to transition to a low carbon economy in a way that is consistent with the Paris Agreement to limit global warming to 1.5 degrees. As a result, obvious candidates to be eligible to the green taxonomy would include solar, wind, other forms of renewable energy, but also energy storage, batteries, energy efficiency in equipment for industrial buildings, transportation, you name it. Hundreds of activities have now been classified as eligible to the green taxonomy, and it will keep increasing over the coming months and years. The reason why this taxonomy is crucial is because from an investor point of view, and from an asset management point of view, we will soon have to disclose the extent to which the portfolios that we manage on behalf of our clients are aligned. In other words, comprised, or to what extent do we invest in companies that derive a certain percentage revenue from those activities derived from or eligible to the green taxonomy. So some companies can be a pure play. I would think of a Vestas or solar panel manufacturers, or they can be from holdings or conglomerates. They might have a smaller proportion of their revenues derived from taxonomy compliant activities. So we as investors will have to provide transparency to beneficiaries and end investors of the purity of our portfolios towards that taxonomy. But the regulations goes further to the extent that it will also require companies to be transparent on those percentage revenue derived from different activities in line with the taxonomy. And that's critical for us because it's very difficult for us to collect the data and report it to our clients if we don't have a reliable source of data coming from companies in the first place. Obviously, there are ways around it. There are ways to estimate those data, but there's nothing like a proper data point, which preferably has been audited by a third party. So back to your question, how will obviously those requirements on corporate reporting definitely apply to European companies, but we are global investors. We manage billions of assets made in portfolios that are made of companies that are involved in the green economy, but these are by definition global portfolios. And typically 50% of those portfolios are made of US companies. So, I mean, it's very clear that US companies should expect a raft of questions from European investors or investors. It could be a US asset manager distributing a fund in Europe, because those disclosure requirements will apply to all funds sold into Europe. So a BlackRock, for example, or a Vanguard selling funds into Europe will also ask those questions, not only to European companies, but also to other potentially US and other international companies. So I mean, this whole regulation is going to, yes, considerably increase reporting requirements and eventually lead to some harmonization of the key data sets required from companies and also from investors to end clients.
So thanks, Eric. And you touch on something that I want to ask also, which is, how this translates to the US market. So I'm going to pull in Selena and Lisa on this as well. Lisa, would love to get your thoughts on, at the EU taxonomy, as Eric addressed. What elements of that taxonomy you think could be deployed in the US over the next 12 months, if not already?
Well, it's an interesting question. And I think that for the most part, US companies are not necessarily looking to the EU taxonomy as a way to increase their reporting. But what I think this does in general is continue to put pressure on US companies to think about the ways that they do increase their reporting, to think about all of the things that Angela was saying that she does with her company and the kind of the canvassing of stakeholders, and really importantly, what resonated with what she said with me and what I often speak to clients about is kind of getting credit for what you already do, taking stock of where there have been initiatives and finding a way to disclose those initiatives that's going to be relevant to a company's stakeholders. And I think that things like increased taxonomy and increased pressure from investors are all putting pressure on US companies to think about the way that they deal with their stakeholders and the way that they report on these measures.
Thanks, Lisa. And Selena, you can follow up on that question, but also I'd love to hear your thoughts on whether you've seen any tangible evidence of actions being taken by companies to mitigate the possibility of being seen as an outlier in a negative sense by investors due to the EU taxonomy.
Yeah, thanks, Gus. I mean, I think, some companies are already planning and preparing for application of the EU taxonomy. And I think the most sort of sophisticated are trying to be preemptive in their approach around ESG integration and trying to be ahead of the curve in the debate so that when they are asked those questions by institutional investors, they have in place and are able to articulate quite clearly what their ESG investment strategy is, where ESG lies within the governance of an organization, what kind of metrics they are reporting against, how they're monitoring ESG. The taxonomy itself, just sort of to expand on what Eric was saying, principally focuses on environmental factors. There are other pieces of key European legislation, including the Sustainable Finance, the SFRD, and the Non-Financial Reporting Disclosure directives, which provide a broader context of ESG and sustainable disclosure. So the Non-Financial Reporting Directive, for example, and I would quote this as really probably one of the key sort of regulations in this area, requires large EU-listed companies to report on sort of like 4 buckets of sustainability issues relating to environment, social and employment matters, respect for human rights, anti-corruption, and bribery. And actually, there are plans to expand the scope of that disclosure to other sustainability factors, including scenario analysis and contribution to the SDGs. So, and that's been translated, for example, from a UK perspective, which I also cover, into strategic reporting. And I think that that creates a sort of like backdrop against which many issuers are sort of setting their targets in terms of being able to provide that kind of non-financial reporting and disclosure, because this is increasingly requested and required by investors. There are other pieces of legislation as well in the UK which impact how investors are engaging with companies, including something called the Stewardship Code.
Right.
And we've got a very new Stewardship Code of 2020. Some of the largest institutional investors, household names, are signatories to this code. And this code will requires a much more proactive engagement by asset owners and actually indeed service providers with companies, including in ESG and sustainability matters. And it does apply to the investments, not just in the UK, but also outside of the UK. And that's how it touches, if you'd like, on US companies as well. Okay. So you've got, sort of a plethora, if you'd like, of sort of like different pieces of regulation, which have this extraterritorial effect and which will directly impact US issuers.
Okay. So obviously, as you all know, one of the big issues here in the US, given the fact that we are somewhat slow in terms of the take-up of ESG, has been standardization. And the lack of it just has been, confusing to many issuers as well as to some partial, passive observers of the marketplace. So, Lisa, on the issue of standardization, how does this environment of frameworks and more frameworks impact investors' time horizon when evaluating between U.S. and European investment opportunities? And what issues are they considering when they make that determination?
Well, first, I think that the multitude of frameworks has been an area that has actually hindered the development in some ways of companies in adopting a framework, because there has been historically, and still is to some extent, a little bit of reticence for some companies to pick a winner when picking a winner involves significant integration into their companies, and then the idea that it's not actually what their investors or others want. And so that's been that's been a little bit challenging, I think, for companies. And that's where you've seen, for instance, BlackRock's endorsement of SASB last year have a real impact on behavior, where, you know, in December of last year, I think there were around 100 companies that reported in a SASB compliant manner, and by the end of this year that had grown to nearly 550 companies. And so you've seen, as investors have coalesced again around what they think is important and signaled which of these standards are important to them, there's been some movement there. In terms of a time horizon, I think there's a little bit of a split. You have permanent capital like the BlackRocks, the Vanguards, the State Streets of the world that view things on a very long time horizon. And then you continue to have in this arena the age-old debate that we've had for many, many years in the US about short-termism versus long-termism. I don't think it is unique to the ESG space, but it has expanded to the ESG space, and it's taken on a different level of consideration and concern in what are investors willing to be patient about, what sorts of investments and what sorts of opportunities do they view with a long-term lens. And I think a lot of the issues that come up in the ESG space really have a long-term type of view. When you're talking about reducing carbon footprints, when you're talking about plans for 2030 and 2050, those are necessarily long-term views. They tend to align with where investors have shaken out historically, the ones who are willing to be more patient capital, as they have sometimes described themselves. But it definitely pressures companies on another level to think about how they satisfy, how boards satisfy their fiduciary duties to take consideration of all stockholders into account, and how companies allocate their resources and their capital in ways that are responsive to what investors and stakeholders say they want in a world in which the level of stakeholder engagement is ever increasing.
That's tremendous. And Eric, as our resident investor, love to get your take on Lisa's thoughts here with respect to short-termism versus long-term focus.
Yeah, well, I cannot agree more with what Lisa just said, and I think the transition to a low-carbon economy and an expectation that companies turn net zero by 2050 is very high on our agenda. Now 2050 sounds like a long time away, but for some businesses, this is not exactly a detail, especially if your business model relies on fossil fuels, either as a producer or as a user or as a transformer or you name it. So even though 2030, 2050 may sound like a long way away, because of the strategic nature of this transition, what we want to see as investors is that capital allocation, CapEx, is being deployed, not in 10 years' time, not in 5 years' time, but starting next year to initiate that transition. So when typically we engage with companies, well, number one, for example, in the power generation industry or in the fossil fuel industry, number one, we want to be reassured that A, there is a commitment to transition over the medium to long term, but number two, that that plan is credible and is backed up by CapEx. So that yes, it is more than talk, that companies walk the walk. That's really our expectation, and the reason why we do so is, well, number one, of course, we want to be part of that journey and potentially capture the upside that may come along with that transition. And number two, obviously, we want also to play our share as being responsible investors. I mean, in your case, this is particularly true because we are family-owned business, so Pictet is over 200 years old, and so we have a tradition of managing our assets for the medium to long term. So I mean, the two go exactly hand in hand. But yes, I mean, that resonates very well. My point is that a focus on the medium to long term also comes with an attention to what's happening tomorrow,
Right.
to make sure that everything is consistent.
Tremendous. Thank you. So thank you, speakers. Let's move on to our final discussion topic and address some of the issues that issuers and investors need to be aware of in 2021. So we found a piece of research by Yardeni Research and Refinitiv that focused on corporate earnings. And basically, the corporate earnings performance is projected to drop by almost 17% in 2020 compared to the prior year, primarily due to the impact of the coronavirus pandemic. And as a result, quarterly earnings in the second quarter of 2020, just as a comparison, dropped 32% year over year. Correspondingly, shareholder activism is also decreased significantly in 2020, as the number of companies targeted fell by 20% compared to the prior year. Again, largely due to the outbreak of COVID-19 in March, which would typically be the peak of proxy season. Many activist campaigns were shelved or quietly settled as companies and activists focused on the fallout of the pandemic. And then also our discussions with bankers and activists Defense Council anticipates an increase in activity in 2021 as activists assess how companies navigated the pandemic. And with the increased focus on ESG investing, activists are ramping up on the incorporation of ESG and then primarily environmental and social components in their campaigns. I think last quarter we saw Exxon settle with Engine No. 1 LLC and the ESG activist. So with that as background, my question to Lisa to start off is, what steps should companies take to mitigate the possibility of an ESG activist challenge?
Well, I think it's twofold. First, despite us seeing activism being publicly down last year, I think we've started to see just this week and this morning returns from activist funds indicating that for a number of them, they had best ever returns and market beating returns. So I think that that's really significant that even in a year that's down, their tactics and the ability of activists to engage and deploy their capital results in gains for them. And I think that preparation for activism, particularly in the ESG space, is kind of takes on two big points. And the first one is performance. And that's almost a non-starter because poor performance is going to be attractive to an activist, and companies have to manage their businesses in a way that generate returns for their investors in order for them to be generally happy with their performance. But the second, and so that is its own kind of management bucket. But the second piece of it that I think is really critical is that level of stockholder engagement. And I don't mean kind of like lip service or putting a deck together or just having meetings with stockholders, but I mean really engaging with them and understanding their priorities. What are their misunderstandings about the company? What are their concerns? What makes them hopeful about the stock? And then demonstrating effective listening through the board, through the long-term strategic plan, through all of the disclosure that comes out. And that kind of commitment and dedication to engagement over a long period of time signals to investors that a company is working with them and listening to them, and makes them much more likely to be able to remain credible with their stockholders, and also stave off an activist from from investing in their stock, because the level of engagement and commitment from other stockholders for the activist demands and thesis will not be as strong as companies that haven't done that kind of work.
Right, and that's a perfect segue to Selena. In 2019, we saw BP relent to a challenge from Climate Action 100 Plus to align its disclosure strategy to the Paris climate goals. Have you seen any recent and notable ESG activist challenges in the UK or other European markets?
Yeah, there's definitely been a flurry of ESG sort of activist activity in the UK. I mean, indeed, this webinar is sort of like timely. Today itself, the Investor Forum, which is a very influential body in the UK, its members represent asset managers accounting for 1/3 of the UK's FTSE all-share market cap. They have actually put out a call to the UK government to try to consult on introducing a kind of climate, say on climate regulation. In other words, sort of like basically getting companies to put their climate policy up for an annual vote. Actually, this had been trailed a little while ago in terms of say on transition, and actually that that's quite telling in terms of what the current sentiment is like in the market. We've also seen very recently a major global international bank, which had actually made, and one would have said, oh, fantastic, they put out a statement setting out their targets with respect to sort of carbon neutrality. But what was lacking, and this picks up on sort of Eric's point about sort of detail and specificity, what actually a institution's doing, they didn't actually map out how they were going to get and achieve their target. As a result, they were subject to attack by investors, and a resolution has been put forward to challenge them. So these are very sort of current and sort of hot topics. I mean, in addition to environment, which is obviously has retained its sort of prominent nature during the pandemic, of course there have been other issues which have come to the forefront, including on the S side. And in the UK, we had last year a very notable example involving a retail company and issues around their supply chain, which was brought into focus. So, I would say in terms of, what issues companies should be considering to mitigate, ESG is so broad in nature. It could come, it could come from anywhere. It could be around your cybersecurity policy, what you're doing in terms of data ethics, and actually, again, another global player was recently downrated because of its policy in terms of sort of its on data governance. So I think it's not just environment. Companies which traditionally hadn't been even subject of activist interest, for example, in the travel sector, are now facing increased scrutiny by activists because they faced pressure during the pandemic. So the landscape is really changing. And it just cannot be ignored any longer.
Understood. Before we jump to Q&A, I want to pull Angela back in into the discussion. So as background, Angela, in Q4 of last year, we saw the announcement of the Big Four accounting firms releasing metrics in partnership with the WEF for companies to use ESG reporting internationally. And this news came shortly after the 5 ESG standard setters agreed to work closely on aligning their various standards and frameworks. So my question, Angela, is with the proliferation of sustainability reporting standards and frameworks to choose from, is it simply a matter of finding the right tool to solve the problem? And I'm asking, given your recent work on right-sizing ESG disclosure process at your company, any thoughts?
Yeah, I mean, I think Madeline and I talked about it a little bit, I think, in the first one. And I think to Selina's point, it sort of ties in nicely because, of course, there is no right size fits all because, one, companies have different areas of focus, which I said, but also the world is changing. And so one of the things we've seen from investors this year is increased interest, rightly so, in what we're doing in COVID response. How are we keeping our employees safe? Are we continuing to execute against 5G while keeping our employees safe? And of course, social justice in the US has been at the front of top of mind, and I expect it will, rightly so, continue to be. There's lots of things happening in the US right now that we don't have to get into, but I think we're going to see increased interest from investors, policymakers, and other folks on issues as they continue to arise, things we're not even necessarily thinking about maybe 6 months ago or whatever. So I'm encouraged by the discussion of these combining, because I think you could have fewer, but I don't think there's going to be a possibility for one size fits all, because I just think there's so, as Selina just said, ESG is so broad. It's everything from cybersecurity to corporate governance, to the size of your board, to your tax policy, to your environmental goals, to how you're managing your supply chain, I could go on and on and on, but, and rightly so, I think those issues all need to be looked at, but at the same time, I mean, that is so broad and covers so many topics. And so I think you don't want to be so broad but have no depth. You want to make sure that you're also looking at things. It's not just about, as we said, pushing out a bunch of data. It's about how are you addressing these key issues.
Understood. And again, we're going to be jumping to Q&A, but before we do that, we wanted to get your thoughts. Each speaker, we'd love to get your prediction in 2021 of an event that you think will really impact the ESG marketplace. So, Angela, since you just spoke, we'll start with you.
Well, one that really shook last year was the BlackRock CEO's letter, and I think everybody's eagerly awaiting that come the end of January. I don't know that it will shake the ESG landscape, but it certainly will, I think, set some interesting guidance. And so I think maybe a new Biden administration might have some interesting, they've already made some announcements around what might happen, and so I think that might potentially also have some focus for companies.
Understood. Okay. Next would be Lisa.
And I think for 2021, we're looking at the recovery era for companies coming out of COVID. And as we get more of a handle on it and folks are hopeful about vaccination, how companies will demonstrate their resilience and their recovery and the ability to generate winners and losers from that era. And I think that boards of directors and management teams should really be focused on how they differentiate themselves coming into that recovery era.
Okay, thanks. Eric, you next.
Yeah, well, I think we've spoken a lot about shareholders, but from our point of view, when we talk about engagement and this is not confined to investments through equity holdings. It's definitely something that is that we are conducting together with our corporate bond colleagues. So bondholders, I think, is also a crowd of investors that we expect will also voice, express their views, not only in terms of analysis, demand or requirements for better data and better information, but will also, together with equity investors, when they both have skin in the game, will probably speak from the same voice and push in the same direction.
Right.
That's definitely what we are doing within PICTE, is that when different teams across different asset classes have skin in the game of the same companies, that we push together in the same direction.
Perfect. And Selena, your thoughts finally on 2021 predictions.
Yeah, if I can, just one sort of slightly negative and perhaps one a little bit more positive. I mean, I expect we'll see, a little bit more in terms of litigation or threatened litigation appearing as companies are also called to account for the commitments they made in 2020, whether it was in relation to social, trust capital issues or beyond. And so I think there's going to be a little bit more activity, if you'd like, in that side of things, and also some sort of soft litigation and investigations. On the more sort of positive side of things, if you'd like, and sort of another area which has been developing is on incentivization, money talks and remuneration at the end of the day. And there's been increased sort of examples of major global corporates introducing ESG-linked remuneration policies. A significant number of the FTSE already do that, over 40%. At the moment, sort of 2019 figures were about 9% of the all share, but I expect that figure to increase as investors, regulators, and others expect to see a bit more of a linkage actually between remuneration and ESG outcomes.
Tremendous. Thank you for your inputs, speakers. I'm going to pass it on now to Madeline, because I believe we actually have some questions coming in from our listeners.
Yeah, we do. Thanks, Gus. We just have 5 minutes left, so I want to start quickly, Selena, with you. Speaking of oil and gas, we have a question from the audience about what guidance would you give as the oil and gas sector seeks to embrace growing expectations around ESG principles and reporting. They note that industry seems to be have particular challenges in the ESG area.
Oh yeah, big question for a big industry. I mean, I think it's sort of twofold. One is, the best thing is to be transparent and also realistic and manage expectations of investors and other stakeholders. Energy transition, which I think is principally what we're talking about, can't happen overnight, and it also needs capital. And I think actually having a clearly articulated plan about what companies are doing, either to reduce their carbon footprint, and actually thinking about all of the different levels from scope 1, scope 2, scope 3, and there's now increasing focus on scope 3, is going to be critical. But just having a very clear and manageable strategy in place on energy transition is, I think, the key takeaway.
Excellent, thank you. Eric, question for you. What are investors' expectations as to a reasonable pace of improvement for an issuer's ESG program, and does that vary by industry?
This is a broad question. Look, when I think obviously it depends on the issues, but I think when we engage with companies on specific issues, whether it is governance related or related to the points that Selina just mentioned on the transition for an oil and gas company to a greener, cleaner business model, those things won't happen overnight, obviously. But typically we set ourselves a 2 to 3 year horizon to see meaningful changes when we engage with companies. So we're not talking about weeks, we're not talking about decades. We don't want engagement to turn into a dialogue into perpetuity. That wouldn't be helpful for anyone. But typically 2 to 3 years is the sort of horizon that we're looking to see meaningful changes when we engage with companies on specific issues.
Absolutely, thank you. Angela, what have you witnessed with changes in ESG, if any, with regard to diversity, equity, and inclusion?
In terms of changes, I mean, I think it's just becoming, it has always been an issue, something that needs to be a focus of a company to work on. I think now there's much more requirement around what are the programs, what are you actually doing for diversity, equity, inclusion, rather than just saying, we believe in diversity, equity, and inclusion as a company, which is good. Hopefully all companies can say that, but to say, what are you actually doing to, as Eric just said, make meaningful change? This is another issue, I think, that takes time and is not going to change overnight, but you have to start doing it and continue to do it. I think we're seeing an increase in tying diversity and inclusion goals to executive compensation, as Selina just said. And I think this is going to be a big issue. I'm in the tech sector. Of course, we have a lot of challenges, the tech sector in general, with diversity and inclusion, and which needs to be rectified. And so I think this is going to continue to be one of the major areas of focus from a human resource perspective, or from a social perspective in the ESG.
Thank you. And I think last question for Lisa. More ESG data is not always better for investors' consideration, as it often lacks context or isn't verified. But are there key issues or data points that investors focus on that offer the best insight into a company?
And I think that's a really interesting question. And I think that's an interesting question coming from a company. And I actually advise often my clients to flip it and to say, you tell investors, you define what is important and material, however you define that for your company, and let them know what they should be focused on for you. Because an investor or a group of investors or a bunch of standards coming in and saying, okay, this is what we want to see. What we've seen is that companies then say, that doesn't really apply to our business. That's not how we think about things. And so there's a little bit of an onus on companies in sort of taking back the narrative and controlling how they view these issues and what's important for the company, and then letting their investors and other stakeholders know what they think that is and how they think about it.
Excellent, thank you. I know there are a few extra questions that we did not have time to address, but we'll be sure to put thoughts in the email that we send around with the link to today's session. I want to thank everyone for joining and hand it off to Gus for closing remarks.
Thanks, Madeline. To Angela, Lisa, Selena, and Eric, many, many thanks for taking the time to speak with us today. Hopefully this will be the first of several we can conduct with you as we transition through what was a hell of a year in 2020 into what hopefully will be a better year in 2021. But again, we appreciate your time. We thank our listeners for listening in, and you will be receiving a recording and a recap of this call. So on to better things in 2021. Enjoy, take care, and thanks.
Thank you.
Thank you.